Hi, it's Rishi, and welcome back to another episode of Investing. When you see a stock chart like this one, the data that's being shown represents a price performance of a stock throughout a specific time frame. But what actually causes these prices to move up and down? Well, today in this episode, we're going to be discussing 7 different factors that cause the price of a stock to fluctuate. Fundamentally, supply and demand is what moves the stock price. For example, if there's a very high amount of demand compared to the amount of supply available, that means that investors are competing for the limited amount of shares and they're willing to pay more for these shares, meaning that the price will go up. Conversely, when there is more supply than there is demand for a stock, this means that the price of the stock will go down. This is because there are more shares available than there are investors willing to buy them. The price of a stock is significantly influenced by the financial performance of the company issuing it. Investors' perceptions on the company's value and prospects can be determined by factors such as sales growth, earnings, and profit margins. To be clear, I'll explain what these 3 factors mean. Sales growth refers to the percentage increase in a company's revenue over a specific period, indicating its performance in generating more income from its core business activities. Earnings refers to a company's profits or net income. Profit margin refers to the percentage of revenue a company retains as profit after accounting for all the costs and expenses. The news that is brought up that affects a company's management, financials, or prominence can all have a direct effect on a company's stock price. Announcements such as executive retirements, departures, and designations cause investors to be unsure of what the future holds for this company, causing the price to fluctuate. On a more broader note, the sector that a company belongs to can also have an impact on the share price of that company. This is because industries that are experiencing a lot of growth tend to attract investors to those companies themselves. Stock prices have an inverse relationship with interest rates. As interest rates decline, young companies that rely on borrowing are able to access capital for a cheaper price. They can allocate this money towards expansion, research, and development, which boosts a company's growth prospects and, in turn, positively affects the stock price. When the interest rates are higher, the borrowing cost becomes higher, causing a business to reduce their funds towards innovation. This can negatively affect the company's stock price. Large-scale economic events can trigger rallies or sellouts in stocks of different regions and industries. For example, let's take one of the largest global economic disasters, such as the Eurozone debt crisis. The Eurozone debt crisis was a complex financial crisis that affected several European countries. This is because they borrowed excessive amounts of money and were not able to pay off their debts. From this, many multinational companies were affected because they had less profit in European countries that they had significant exposure in. This caused the stock to decline. We've covered 6 different topics today, and I still think that we're missing one of the most important ones, and that is perception. What do these investors actually think behind the earnings, the revenue, the new executive changes? This is what's actually driving the supply and demand, because it's what they perceive of the data. It's not the actual data that's affecting the stock price. It's the investors themselves. Thank you so much for watching this video, and I hope you enjoyed. Make sure to like, subscribe, share, and comment any suggestions you have down below. I hope to catch you in the next one.